Guys, welcome to my channel Commerce Specialist, where you'll find videos covering syllabus outcomes of various academic qualifications and professional certifications. First of all, I'd like to thank everybody who has supported me so far, all my subscribers, dear and near ones, for the support up till now, your comments, your suggestions. I'm really grateful to all of y'all. Guys, today's video is a continuation of Accounting Basics. This is part 2 of Accounting Basics, where we'll talk about how to give journal entries, how to analyze journal entries for two effects, debits and credits, how to record them into a journal, how to prepare T accounts, ledger accounts, how to balance the ledger accounts, do the balance carried down, brought down, and a little bit of trial balance as well. So let's begin with the topic. Guys, to save time, what I've done is I have written few transactions here. This is relating to the business of Mr. A, who is a car dealer. He buys and sells cars. These are transactions. What are transactions? Transactions are activities, events, and happenings in business which affects the accounting equation. So we won't call an activity a transaction unless it has an impact on the accounting equation, which means unless it changes some assets, liabilities, capital, income, cost, revenue, all of them, some of them, or few of them, right? So that's a transaction. Here there are a few transactions. The very first thing we need to know is the accounting concepts and principles. The very first concept we talk about when we talk about basics of accounting is the concept of separate entity, also known as the concept of business entity. What does the concept says? The concept of business entity says that the business and the owner should be considered as two separate individuals. Both have their separate identities. Alright, so if the business is considered as an individual, the owner is considered as a different individual, they both have their distinct identities. So what? The point is, we are doing accounting for the business, not for the owner, which means we'll be monitoring changes in the business. What is happening in the business? Are assets increasing, decreasing? Liabilities are increasing or decreasing? So on and so forth. So this concept is very important. We are looking at things from the business perspective, not from the owner's perspective. Number one. Number two, just like the Newton's third law of motion, to every action there is an equal opposite reaction. We are talking about action and reaction, two effects. Ladies and gentlemen, the second accounting principle is known as the dual aspect. We also call it principle of double entry, which states that in all these transactions, there are minimum of two effects, debit and credit. And both debit and credit has to be equal. So our first task is to look at the transaction, find the two effects, debit and credit, relate them to the rules of debit and credit, and then things become very easy. Then we are in a position to record them here. So let's begin with the first one. It says Mr. A invested in business cash 800,000. Here we need to understand, please remember, what we need to know is we have to look at the before and after effect. Means at the moment the business is empty, nothing is here. And it is January 1st. Before January 1st, there was no cash into the business. Now there is cash of 80,000. Mr. A, the owner, has invested cash into the business. Before, cash balance was 0. Now it is 80. Cash is an asset. From 0 to 80, increase in an asset. As per the rules of debit and credit, we record it as a debit. So I'm writing here January 1st, cash debit. Reason being increase in an asset. I'm debiting cash. So this was the first effect. An asset is increasing in the business. Why? Because the owner has invested. Remember, this is very important, before and after. Before, cash balance was 0. After the investment, cash balance in the business is 80,000. 0 to 80,000 is increase. Increase in an asset is a debit. I have recorded it in the debit column. The other effect is invested. The word invested reminds us of investment. And investment means capital. So if you look at before January 1st, Mr. A had no capital. His capital balance was 0. Now that he has invested 80,000, from 0 to 80, his capital is increasing. As per the rules of debit and credit, increase in capital is a credit. Please go back to part 1 of accounting basics. There I have discussed rules of debit and credit. I have written the rules of debit and credit for you. For now, you should know increase in capital is a credit. Therefore, I am crediting capital of Mr. A. Capital of Mr. A. Increase in capital is a credit. So I recorded. First transaction has been recorded. Looking at the second one now. The second one says, purchase furniture for cash 4,000. Now, ladies and gentlemen, again I need to remind you, we are looking at the before and after effect. Before 2nd of January, there was no furniture. The balance of furniture was 0. Now that you have purchased it 4,000, from 0 to 4, the balance of furniture is increasing. Furniture is an asset. By definition, assets are resources possessed by a business, something which is useful for us. So furniture is an asset. Before it was not there, now it is. Before the balance was 0, now it is 4,000. 0 to 4,000, increase in an asset as per the rules of debit and credit is a debit. So I'm going to debit furniture by 4,000. Reason being increase in an asset. Alright, furniture balance has increased. What about cash? We purchased furniture, we paid cash. Cash is also an asset. So if you are paying cash, cash is going out, the cash balance is going down. Decrease in an asset is a credit. So I'm going to credit cash by 4,000. So what happened in transaction 2 is, one asset is increasing, the other is decreasing. So the asset which is increasing, as per the rules, I have debited furniture. The asset which is decreasing, as per the rule, I have credited that. Coming to the third transaction. Again, purchase furniture, but this time on credit from Mr. Y, 1,000. Now when you're buying furniture, furniture is an asset. Obviously you buy, the asset value increases. Increase in an asset is a debit. So I am debiting furniture again by 1,000. Entry number 3, that's January 3rd. Furniture debit again by 1,000. Ladies and gentlemen, look at this. You're buying on credit. You're buying on credit means you're buying but you're not paying. So which means you have to pay. What we have to pay is a liability. So before 3rd of January, there was no liability for Mr. A, for the business. Now there is. That means liability before it was 0, now it is 1,000. 0 to 1,000, the liabilities are increasing. As per the rules of debit and credit, increase in liability is a credit. So I am using the term accounts payable. Accounts payable. Whom you are buying from? Mr. Y. An increase in liability is a credit. Alternatively, instead of accounts payable, I can also use creditor. Creditor Mr. Y. These are terms used when you buy something and you don't pay. So it's a liability. Increase in a liability is a credit. So buying furniture, increase in asset debit. Because you have to pay, increase in liability is a credit. What's happening next? Entry number 4. Paid Mr. Y 7,000 cash. So if we are paying Mr. Y, that means we owed him. So if we are paying Mr. Y, that means our liability is going down. Whenever we pay to our suppliers, the liability goes down. Decrease in a liability is a debit. So I'm going to debit accounts payable Mr. Y. Reason being decrease in liability. Accounts payable Mr. Y. This time I'm debiting because I'm paying 700. So decrease in liability is debit. And then what is the other effect? I'm paying cash. Cash is leaving the firm. Cash is going out of the business. Cash is an asset. The value is decreasing. When the asset decreases, as per the rules of debit and credit, we credit. So I am crediting the asset by its name, cash. Decrease in an asset. I paid 700. So entry number 4 was actually payment of a liability. When you pay a liability, your liability decreases as well your asset. So So decrease in liability is a debit as recorded already here, and decrease in asset is a credit. Entry number 5, sold some furniture not suitable for the business for 2,000 cash. What is happening, guys? We are selling furniture. Now if we are selling furniture, when we purchase furniture, what we did? We purchased furniture, we debited furniture. Look at entry number 2 and 3, 2nd and 3rd January. Whenever we buy furniture, we debit furniture. When we sell furniture, asset is going out, asset is decreasing, we will credit furniture. This much we know. What are we going to debit? So we are selling furniture, we are getting cash. Look, sold furniture for cash 2,000. We are getting cash. Cash is an asset coming into the business, increase in an asset. So what I'm going to do here is, I'm going to debit cash. Because we are selling, I'm receiving cash. Cash debit 2,000. And furniture, now that it is gone, I'm going to credit that. So furniture credit 2,000. Furniture sold. Now what is happening is, if you look at the next transaction, I've written in this transaction number 6 in black. What does it say? It says purchase goods. Ladies and gentlemen, you need to know the meaning of goods. Goods means items either purchased or manufactured for the purpose of selling. So if I have a car manufacturing factory, why do I manufacture cars? To sell. If I have a car showroom, I buy cars from somebody. Why do I buy? To sell. So cars will be my goods. Another name for good is merchandise. You call them merchandise, goods or stock, means items which are either manufactured or purchased for the purpose of selling. So I wrote here for a purpose. Mr. A is a car dealer. So he is buying goods. That means he is buying cars. Please remember, whenever we buy goods, we use the word purchases. Anything else we buy? Look, if we purchase furniture, I debited furniture. In entry number 3, we purchase furniture, I debited furniture. Furniture was purchased to be used in the business, whereas goods are purchased to be sold. So there is a difference. We are buying furniture to be used in the business, so that becomes an asset. But when we buy goods, we are buying them to be sold. So whenever we buy goods, it says purchase goods. We use a special term which we call as purchases. And why I'm debiting? Because it increases our cost. Purchase goods for 20,000. Now why cost? Let's say I purchased a car for 20,000. What is my cost? 20,000. If I buy one more car for 20, my cost will be 40. So the more you buy your goods, your cost goes up. And as per the rules of debit and credit, increase in cost is a debit. That's why I debited purchases here. Alright, what's happening next? Paid cash. Purchase goods for cash 20,000. So I purchased goods, cost increases, I debited purchases, I'm paying cash, so decrease in an asset, I'm going to credit cash 20,000. Next transaction is that of a purchase again, purchase goods. As I told you, whenever we purchase goods, the cost increases. Because we are buying goods, we use the first special term purchases. So I'm going to debit purchases again. How much this time? 30,000. And what? We are buying on credit. Credit means we have to pay. Our liability is increasing. Increase in liability is a credit. So I'm going to use the term accounts payable. Whom I'm buying from? I'm buying from Mr. K. So I'm Mr. K, 30,000. So if I give you the reason, purchase debit, increase in cost, accounts payable credit, increase in liability. Next transaction. Number 8 is I'm paying Mr. K 5,000 cash. Why am I paying? Because I purchased goods on credit. I had to pay. There was a liability. Now that I'm paying the liability is going down. As per the rules of debit and credit, decrease in liability is a debit. So I'm going to debit accounts payable Mr. K, how much? I'm paying 5,000, so I'm going to pay 5,000. And since I'm paying cash, decrease in asset, cash credit, 5,000. Payment of liability. Transaction number 9 requires special attention because this time we are selling goods. We purchase goods because we wanted to sell. Now we are selling. So whenever we sell, we get the money. The money coming in is known as income. So the more we sell our goods, our income increases. But that's different from transaction number, I would say, number 5. See, it says sold furniture. So I credited furniture here. This time I'm selling goods. Whenever I sell goods, I use a special term, sales. Whenever I sell goods, I use a special term, sales. And sales is always credited. Why sales is always credited? Because increase in an income. So sales will be credited always. Whenever you sell goods, you credit sales, increase in income. What are you going to debit? Are we getting some money? The answer is yes. Sold goods for cash, 40,000. So we are selling goods and we are receiving cash. Cash is an asset. Asset is increasing. So I'm going to debit that. Cash debit. How much we are selling goods for? 40,000. And I'm going to credit sales with 40,000. So cash debit, increase in an asset, sales credit, increase in income. You can call it increase in income or revenue, it's the same thing. Next transaction is again of a sales, sold goods on credit. Now look, normally what happens when you sell, either you get cash. So if you get cash, you debit cash. Here you're selling it on credit. That means you're selling but you're not receiving. You have to receive. What you have to receive is your asset. We call it receivable. So if you look at entry number 10, before entry number 10, you never had any amount receivable from Mr. R. There was no receivable from Mr. R. But after 10th, there is a receivable. Increase in receivable, increase in asset. So I'm going to debit it. I call it accounts receivable because account receivable is an asset. So I'm going to debit it. Accounts receivable, Mr. R, I guess it is Mr. R, yeah, yes, 50,000. Means you're not getting money, you have to receive. And if you're selling goods, you have to credit sales because increase in income, 50,000. So if you compare these two entries, in entry number 9, we sold goods for cash. So we received cash, I debited cash, I credited sales, increase in income. In entry number 10, I sold goods on credit. On credit means on account. That means I'm selling, but I'm not getting the money. So I have to receive. What I have to receive is my asset, is my receivable. So increase in receivable, increase in asset is a debit. And I credit sales, increase in income. Coming to entry number 11. What happened on January 11? Cash received from Mr. R. Your customer is paying you money. The business is receiving cash. Cash is an asset. So if you are receiving cash, the cash balance is going up, assets are increasing. How much we are receiving? 15,000. So I'm going to debit, cash debit 15,000. That is increase in an asset. And Mr. R has paid us, so his receivable balance is going down. Receivable is an asset. Once a customer pays, the value goes down. So decrease in receivable, decrease in asset is a credit. So I'm crediting account receivable, Mr. R, by 15. So another way to look at it is, when we debit receivable, that means we have to receive. When we credit, that means most probably we have received it. There are other possibilities, we'll discuss that later. So generally, receivable debit means we have to receive. When we receive cash, we credit receivables, decrease in asset. Next, guys, this is important. Entry number 12, 12th of January, paid rent for the current month, cash 2,500. We are paying rent. Before 12th of January, there was no rent. Rent is an expense. So as I told you, before and after. Before rent balance was 0. Now that we have paid 2,500, it is 2,500. From 0 to 2,500, increase in expense. As per the rules of debit and credit, we debit expenses. Increase in expense is a debit. So I'm going to debit rent expense. You can simply write rent or rent expense. That's better. 2,500. And because you're paying cash, cash is going out of the business. Decrease in asset is a credit. So I'm going to credit cash. 2,500. Entry number 13. On 13 January, what is happening? This is important, guys. Please pay attention. It says paid 6 months insurance in advance. 6,000 cash. Guys, there is a difference between 12th and 13. In 12th, we are paying rent for the current month. We call it an expense. On the 13th of January, we are paying 6 months insurance in advance. Whenever we pay for more than 1 month, we call it prepayment or prepaid. Prepaids are considered as assets. So before 13th of January, there was no prepaid insurance. The value was 0. Now it is 6,000. From 0 to 6, it is increasing. Prepaid is an asset. Increase in an asset is a debit. So I'm going to debit it by 6,000. Prepaid insurance. 6,000. And obviously I'm paying cash, so I'm going to credit cash. If you're paying by check, you can credit bank. Because when you pay by check, ultimately your bank balance goes down. So if you're paying cash, you credit cash. If you're paying by check, you credit the bank account. Last one, ladies and gentlemen, the last transaction here is actually connected with the first one. So if you look at the first transaction, it says Mr. A invested cash 80,000 in business. When he invested, money came in, cash came in. Cash is an asset, so I debited cash. And because he invested, we know that his capital increases. Investment means capital. Investment made by the owner into the business. So when he invested, cash balance increased, so is the capital account. So increase in cash is a debit. Increase in capital is a credit. That's already recorded. Now what is happening? Mr. A is withdrew cash from business for personal use. The owner is withdrawing cash from business for personal use. See, if he withdraws cash from business and pays an official expense or a business expense, we call it rent. You know, he's taking money and he's paying the rent. So that's official. Concept of business entity. We are doing accounting for the business. So all official expenses are known as expenses. But when you take out money from business for personal use, it's not a business expense. It is termed as drawings. Drawings is a special term used when owners withdraw money from business for personal use. And what is the impact? It reduces their capital. When you invest, your capital increases. When you withdraw for personal use, your capital goes down. When your capital increases, we credit. When it goes down, we debit. But we use a special term, drawings. Whenever the owners withdraw money from business for personal use, we use the word drawing. It is 3,000. So drawing debit, reason being decrease in capital. And cash is going out, so I can credit cash, decrease in asset. So all the entries recorded. The next step is, if you remember the definition of accounting, accounting is an art of systematically recording, classifying and summarizing transactions which can be measured in terms of money. We have already recorded the transaction. Now the next step is to classify them. By classification means to separate. Separate what? If you look at these, you have cash, accounts payable, sales, purchases, everything is recorded in the journal. We call it the general journal. Means all transactions are recorded here. General, everything, nothing specific. But if you look at the first transaction, cash debit of 80,000, that means cash came into the business. And if you look at the second transaction, cash credit means cash went out. So from a layman's perspective, debiting cash means cash is coming in, crediting cash means cash is going out. So how much is left? Cash came in, debit to cash is 80,000. Cash went out in the second transaction is 4. So 80,000 came in, 4,000 went out. How much is left? The answer is 76. But that's true till the 2nd of January. There are so many transactions in which cash is coming in, cash is going out. So what we are going to do is, we are going to prepare a T account, a ledger account, which will have all the cash transactions, whether coming in or going out, and then at the end of the month, we'll be able to see how much is left at the end of the month. That's why, ladies and gentlemen, we prepare ledger account so that we know the balances of each account at the end of the month or at the end of the accounting period. Depends. You can make ledger accounts on a daily basis, weekly basis, monthly basis, quarterly, semi-annually or annually. It depends on the nature and size of the business. So guys, when preparing ledger accounts or T accounts, what we need to do is, we have to look at the entries here. Look at the very first entry, cash. Now this cash is known as an account title. Just like names, Mr. A, Mr. B, Mr. Y, these are names. We call them names or account titles. So the very first account title is cash. So what I'm going to do is, I'm going to make a T account. I'm going to write cash here. And just like a T, you see, this T looks like a T, it's a T account. This side, if you look at my hand, the left hand side is always debit and the right is credit. So this side is, the first one is always the debit side and this is the credit side. What's next? Look at the general. I have made a cash T account, which means I'll only focus on cash, whether it is debited or credited. So in the first entry, cash is a debit of 80,000. So I'm going to write on the debit side, I'm going to write January 1st. Cash is a debit of 80,000. All right. Coming to, there is no credit, entry number 2. Cash is a credit of 4,000. So I go on the credit side, I write entry number 2 or 2nd of Jan, the date. Cash is a credit of 4,000. All right. Please keep in mind, I am only looking at cash, nothing else. So for a second transaction is recorded. In transaction number 3, there is no cash. In transaction number 4, cash is credited with 700. So entry number 4, on the 4th of January, cash is credited with 700. All right. Entry number 5, cash is debited with 2,000. So I can write entry number 5 here. Cash is debited with 2,000. Entry number 6, cash is credited with 20,000. Entry number 6, cash is credited with 20,000. Entry number 7, there is no cash. Entry number 8, cash is credited with 5. So entry number 8, cash is credited with 5,000. Entry number 9, cash is debited with 40,000. So it's a debit of 40,000. I'm going to record on the debit side. Entry number 9, it's a debit with 40,000. All right. Entry 10, there is no cash. Look at debit and credit both, there is no cash. Entry 11, cash is a debit with 15. So I come on the debit side, I write 11. Cash is a debit with 15. All right. Entry 12, cash is credited with 2,500. So 12, it's credited with 2,500. 13th, it's a credit with 6,000. So 13th is a credit with 6,000. And the last one, 14th, is a credit with 3,000 again. So I'm writing on the credit side 14, it's a credit with 3,000 again. Now, ladies and gentlemen, what I have done? I looked at the first account title, which is cash. I wrote cash here. I made a T account. After making the T account, what I did, if cash was debit here, I recorded on the debit side. I gave the reference of the date or the transaction number. Then cash was credit, I recorded on the credit side. This 4,000 is recorded here. So what did I do? If it was debit in the general, I recorded on the debit side of the T account. If it was credit in the general, I recorded in the credit side of the T account. Now what? Now what we're going to do is, we're going to add all these and do a small total here. And we write it very small. We call it footing. F-O-O-T-I-N-G, footing. Footing is the rough total. So if I use my calculator here, if I debit the total of the debit side, so if I total the debit, it is 137,000. So I'm writing it here, 137,000. Total of the debit side, all these amounts. Then what I have to do? I have to do the total of the credit side as well. So if I use calculator and add them up, the credit side adds up to 41,200. So this is 41,200. All right, footing done. I have totaled the debit and I have totaled the credit. Next step, find the difference, which means 137,000 minus 41,200. I need to find the difference, the highest side minus the lowest side. So 137,000 minus 41,200 gives me 95,800. The difference between the two is 95,800. Guys, please remember this, the most important part. The difference between the debit and the credit side is always written at the lower side. Which side is lower? This is 137,000 and this is 41,200. So when you find the difference is always written at the lower side, which is 95,200. I'm going to write here end of the month because this is the lower side, 31st. I'm writing here balance carried down. Carried down, balance carried down means closing balance. So it's 95,800. Draw a line here, draw a line here. This is already 137,000. Closes with two lines, we call it rule off. This 41,200 and 95,800 will also give you 137,000. Rule off. The account balanced. Now, something is very important. If you look at this T account, the cash T account, if somebody asks you, what is the balance of the account? The balance is 95,800. Is it an opening or closing balance? It's a closing balance. Look at the date, 31st of the month, 30th or 31st, whatever. So, end of the month, balance carried down means closing balance, which is 95,800. The most important question, is this 95,800 or debit or a credit balance? Please remember, which side was greater? Debit side was greater. So actually it's a debit balance, but written on the credit side, the lower side, just to equate the T account. So remember, if I give you a T account like this, have a look at this. Let's say I have cash here, it has 100 here and 30 over here. So what's the difference? 70. Which side is greater? Debit side is greater. So I can say this account has a debit balance of 70. But how do I write it? How do I present it? I write here carried down 70. 100 and 100 here. Do you understand this? So if I look at this cash account, what is the closing balance? 70. Is this 70 a debit or a credit? It's a debit balance. Why? Because debit side was greater. I hope you have understood this. Guys, we are going to the second account. Cash account is already done. All the debits and the credits of cash has already been transferred, posted there. This is the word we use, this process. All the debit and credit here, when I copy them here, is known as ledger posting. Posting means transferring. All the debits to cash on the debit side, credit to cash on the credit side. Once ledger posting is done, we do footing. That is the rough total. Once footing is done, we do the balancing. Balancing means finding the difference in the debit and credit. Once you find the difference, write it at the lower side. Alright, this is end of January. One step more before we go to the next account. This is the closing balance. After the end of January, the first day of the following month is 1st of February. So if carried down is here, on the opposite side, you write 1st of the following month, February 1st. balance brought down. Brought down means opening balance. Whatever was the carried down balance, you can write as opening balance. So if you look at balance brought down is on the debit side. Why? Debit side was greater. So carried down is written at the lower side. Brought down is always done at the opposite side. If carried down was done here, I will do brought down this side. First day of the following month. Okay. Next, cash is already done. We have another thing. New account, new name, new account. So cash is done. I'm talking about capital. Capital would be a very small account because there is only one transaction in capital. Capital Mr. A. Okay. So I'm going to make it a very simple, smaller one. So if you look at the transaction, capital is a credit of 80,000. Credit of 80,000 means I'm going to put on the credit side, January 1st. It's a credit of 80,000 and that's about it. There is no other step to do because there is only one transaction here. This is the carried down balance. Okay. Next, as I said, the key is new name, new account. So I'm done with cash. I'm done with capital. Now coming to furniture. So I'm going to make a T account for furniture. T account means just like make a T. Obviously it has a debit and a credit side. Alright, so furniture is here. Transaction number 2. On 2nd January, furniture is a debit of 4,000. So I'm writing January 2nd. Furniture is a debit of 4,000. Alright. 3rd January, again it's a debit 1,000. On 3rd January, again it's a debit with 1,000. Alright. 4th January, there is no furniture. 5th, furniture is credited with how much? 2,000. So if it's a credit, I'm going to put on the credit side. It's 5th of January. It's a credit with 2. And then if I keep checking, there is no furniture. Always check it properly so that you don't miss a transaction. So all transaction relating to furniture has been posted. Now what we need to do? Rough total, which is putting 4 and 1 is 5,000. This is only one amount, no need to do totals. Alright. So 5 minus 2. The difference. 5 minus 2 is 3,000. The difference is 3. Where do we write it? We always write it at the lower side. 31st January, I write balance carried down. 5 minus 2 is 3,000. Add them up. This is 5. Drop a line. This is already 5. Okay. Now what? If you look at furniture T account, what is its closing balance? 3,000. Is it a debit or credit? It's a debit balance. Why? Because debit side was greater. What we're going to do next? Just bring it forward. If carried down is here, it will be brought forward this side. So I can write here February 1st. Balance brought down. Brought down means opening balance. Same 3,000. So I'm done with cash. I'm done with capital. I'm done with furniture. Now accounts payable is left. One T account known as accounts payable. So I make a T account known as accounts payable. I'm using short form accounts payable. Mr. Y. A T account. See what I'm going to do. Looking from the top so that you don't miss. Always when you're making ledger accounts, start from the first transaction so that you don't miss anything. So if I look at the first one, there is no accounts payable, no accounts payable. In the third accounts payable, Mr. Y is a credit with 1,000. So I'll write 3rd of January. Accounts payable Y is credit with 1,000. Entry number 4. Accounts payable Y is a debit with 7. So entry number 4, it's a debit with 700. Now what? If I look at all these transactions, there is no accounts payable Mr. Y. I'm only focused on Y because this T account is accounts payable Mr. Y. And accounts payable is a liability. So credit means we have to pay. Debit means we have paid. So how much is left? Credit minus debit, you know, the difference. If you look at the difference, 1,000 minus 700 is 300. The difference is 300, always written at the lower side. So which is the lower side? The debit side is lower. So I'm going to write here 31st. Balance carried down. 1,000 minus 700 is 300. As soon as I write this, I drop a line here. This will become 1000 now, and I drop a line here. Not here, in line with this, 1000. And you guys know, if it is carried down, closing balance, first day of the following month, we need to do balance brought down, which will be the opening balance. So if carried down is here, brought forward will be done on the opposite side. So I write February 1st, balance brought down, which is 300. So guys, this was ledger posting, preparing ledger accounts, carried down, brought down, closing and opening balance. Now I'm not making all the ledger accounts because the idea was to make you understand how it is prepared. What we're going to do next, because I don't have space here, I am done with accounts payable Y. The next account will be for purchases, then account payable Mr. K, as many accounts payable with different names, separate accounts. Then we will make for sales, for receivables, for rent expense, prepaid and drawings. They keep coming. Alright, we have prepared all the T accounts. Next what? Once all the ledger accounts are prepared, we prepare trial balance. Trial balance. Trial means to check. So in accounting what happens, at regular intervals we check our work. So once all the T accounts are prepared, we prepare a trial balance to see if things are okay. So I'm just giving you a snapshot here how a trial balance looks like and how do we prepare them. So have a look at this. So let's the format of a trial balance look like this. It's a small one just to explain you. So if I do it like this, yes. First one, this is serial number, like 1, 2, 3, 4. This is account title. Account title. This is account number. And this is obviously debit and credit. This is what? Trial balance. Ladies and gentlemen, trial balance is so very easy. I can't tell you. Have a look at this. Which is the first ledger account we have prepared? Cash. Now I have two questions. How much is the balance brought forward and whether it is debit or credit? So if we look at the cash T account, the balance brought forward is 95,800 and it's on the debit side. Look, this is the debit side. So in the trial balance, the first T account I prepared cash. So I'm writing here cash. How much is balance brought forward? 95,800. Which side? Debit side. So in the debit column, I will write 95,800. Second T account, capital. How much it is? 80,000 on the credit side. So I write capital. 80,000 on the credit side. Next T account is furniture. How much is balance brought down? 3,000. Which side? Debit side. So I'm going to write furniture here. 3,000 on the debit side. 3,000 on the debit side. Then comes accounts payable. How much is balance brought down? 3,000. Which side? Credit side. So I'm going to write accounts payable. Mr. Y. It's credit 300, credit 300. So just like this, ladies and gentlemen, when you write all the ledger account balances in the trial balance, debit or credit, in the end, when you total these two accounts, it has to come the same. Once the trial balance balances, that means the debit total and the credit total is the same. That means all is okay, all is well, all is correct up till now, and we can proceed to financial statements. Means making an income statement and a balance sheet, which you call statement of comprehensive income and statement of financial position. So guys, this much for this video. Hopefully I'll be back with a new video on a new topic. I hope you have understood the concepts. If you have liked the video, please share it with your friend and family members so that others can also benefit. Thank you so very much for your precious time.